You've probably heard it before. Just buy SPY and hold it. But what if there are two ETFs, XLG and OEF, that don't just track the market, they've actually outperformed it? In this video, I'll break down what XLG and OEF are, how they've performed, why they pulled ahead of SPY, and whether their edge might continue into the future. Let's start with the basics. What exactly are XLG and OEF? Both ETFs track official indices published by Standard & Poor's. And remember, the S&P 500 isn't the only index they offer. OEF tracks the S&P 100 index, while XLG focuses on an even narrower slice, the S&P 500 Top 50 index. Think of it like the NBA. The other one, S&P 500, is like owning every player in the league. The S&P 100 is like owning just the all-star teams. And XLG? That's like owning LeBron James, Stephen Curry, and Kevin Durant. The absolute elite. These ETFs are built to skim the cream, offering a concentrated dose of the most dominant companies in the US. XLG is issued by Invesco and OEF by iShares, with both charging a modest expense ratio of 0.20%. If these ETFs are that focused on the best of the best, then their performance must have been impressive, right? Let's take a look at how XLG and OEF have actually performed over time. Over the past 1, 5, and 10 years, XLG and OEF have outperformed SPY across the board. As a DCA investor, I am more focused on a long-term, stable return. By doing this, I have backtested from 4 historical bottoms to the end of 30 June 2025. The 4 bottoms are March 2009, the GFC, December 2018, the first Trump trade war, March 2020, the COVID-19, and December 2022, the interest hike. Here, I highly recommend testfall.io. It is a free but very powerful tool. I don't want to waste your time of watching me entering data, so I list the result here. We're going to focus on CAGR, compound annual growth rate, which smooths out returns over time. Starting with the long term. Since March 2009, SPY grew at 16.64% per year. OEF did slightly better at 16.86%, and XLG led the pack with 17% flat. Not a huge gap, but consistent. Now let's move to January 2019, just before the tech rally really kicked in after Trump's first trade war. SPY returned 16.88%. OEF stepped up with 18.53%. And XLG hit an impressive 19.37% per year. The gap is starting to widen. From March 2020, the COVID crash bottom, to now, SPY delivered a strong 23.10% annual return. OEF came in at 24.20%, and XLG outpaced both at 24.72%. Even in a broad rally, the top 50 still pulled ahead. And finally, the most recent stretch, since January 2023, after the long bear market in 2022. SPY did 23.5%. OEF surged to 28.37%, and XLG crushed it at 30.99% per year. That's more than a 7% difference in just a short time. So the trend is clear. XLG and OEF didn't just beat SPY in the past. They've been beating it by more and more in recent years. So what's driving this trend? Why are these more concentrated ETFs pulling ahead of the broader market? Let's break down what's really behind the outperformance. Here's the thing. The S&P 500 isn't created equally. It might include 500 companies, but the index is market cap weighted, meaning bigger companies carry more influence. And this chart proves it. The top 50 companies make up roughly 55% of the index, and the top 100 companies account for about 70% of the total weight. In fact, the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, now make up over 30% of SPY on their own. And as we all know, their performance over the past few years has been nothing short of exceptional, consistently driving market returns and leaving many other sectors behind. So when these giants soar, it's the ETFs that focus on them, like OEF and especially XLG, that reap the biggest rewards. These aren't just, quote, narrow ETFs. They're strategically concentrated in the companies driving most of the market's gains. And in a world where tech dominance is only growing, that concentration has turned into consistent outperformance. Let's get even more specific. Here's the combined weight of the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, plus three more tech giants: Broadcom, Oracle, and Netflix. Broadcom has held the trillion-dollar market cap milestone for some time. Oracle is now worth around $700 billion, and Netflix isn't far behind at around $500 billion. In SPY, these 10 giants make up 38% of the entire fund. In OEF, they account for 53%, over half of the ETF. And in XLG, they dominate with a massive 62% weight. These 10 companies are absolute market movers, and their weight in each ETF tells the story. By concentrating on these titans, XLG and OEF were built to capture way more of their explosive upside instead of diluting it across 400 other companies. This wasn't just hype. It was driven by superior fundamentals, specifically higher earnings per share growth compared to the rest of the market. Now, the big question is, can this outperformance continue? To find out, let's look at the fundamentals: earnings power and investment into the future. In terms of EPS growth forecasts in 2025, the S&P 500 is expected to grow earnings by 9.9%. But many of the top holdings in XLG and OEF are projected to grow much faster. Nvidia, 65%, Meta, 36%, and Netflix, 39%. Only Tesla stands out with a rare negative forecast. But overall, the core drivers in these ETFs are delivering earnings growth well above the market. That's the kind of fundamental edge that supports long-term outperformance. From a long-term EPS growth perspective, S&P 500 earnings have grown about 8% per year historically. Now compare that to long-term projections for the top names in XLG and OEF. Nvidia, 29%. Tesla, Netflix, Broadcom, all above 20%. Microsoft, Alphabet, Oracle, still well above average. These aren't just big companies. They're still growing fast, and that's exactly why XLG and OEF are built to outperform over the long run. Profit margins tell the same story. The S&P 500 averages about 12% net profit margin, but the major holdings in XLG and OEF are far more efficient. Nvidia, 51%, Meta, 40%, Microsoft, 36%, Amazon, Tesla, even they post solid margins of 6 to 10%. These aren't just high-growth firms. They're also profit machines. Owning ETFs like XLG and OEF gives you exposure to some of the most efficient, cash-generating companies in the world. Big tech is betting big on the future, and the numbers prove it. In Q2 2025 alone, Google spent $22.4 billion, raising full-year capex to $85 billion. Microsoft spent $24.2 billion, with next quarter expected to top $30 billion. Amazon is guiding over $100 billion in 2025 capex, mostly for AWS and AI. Meta remains on track for $30 billion this year, with more coming in 2026. Combined, over $240 billion, pouring into AI, cloud, and data centers. And these are the core holdings of XLG and OEF. So when they invest in growth, these ETFs capture the upside. It's not just tech, it's infrastructure for the next decade of returns. So, to wrap it up, XLG and OEF have consistently outperformed SPY over multiple timeframes thanks to their concentrated exposure to the market's top performers. If you believe big tech will continue leading the market, these ETFs aren't just alternatives, they're strategic upgrades. And if you're looking for another under-the-radar ETF with a strong growth tilt, check out my previous video on IWF, the iShares Russell 1000 Growth ETF. It's another smart way to capture long-term growth with broad exposure. Thanks for watching, and if you found this helpful, hit that like button, subscribe, and explore the full ETF breakdowns on the channel.